Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Episode 60 of Real Talk. Well, I'm back from my summer vacation. I was in the Low Country, as they call it, South Carolina, 5 days at the Montage, Palmetto Bluff, and another 5 days in Charleston. Never been to that part of the country. An amazing time. Yes, it was hot and humid, but spectacular food, restaurants, scene, beauty, just a great place to be. So definitely encourage those that haven't been to South Carolina to check it out, even in the summertime. This week, I have Jeff Gleiberman, president of MG Properties, on the show. If you don't know MG Properties, you're not in the multifamily business, because they are an absolute monster in our industry in multifamily. Their average syndication equity raise is somewhere between $80 to $100 million per deal. They have over 32,000 units, almost 1,000 employees, over 100 properties. They've been doing it for 30 years, started by Mark Gleiberman, Jeff's father. Really a titan in our multifamily industry. I hope you enjoy my conversation with Jeff Gleiberman. Hello, welcome to another edition of Real Talk. I'm here with Jeff Gleiberman, president of MG Properties. Jeff, how you doing?
Doing great, Andrew. Thank you for having me.
Yeah, it's good to have you on. This is, by the way, this is like my perfect afternoon, doing a podcast, talking with you, and then on my wall, I've got the Dodger Giant game on. So this is when the real work happens, right? This is like inside Scholar Kirsh of watching baseball and doing podcasts. I don't think we do any lawyering here.
On one of the hottest days of summer, too.
It is pretty hot, although I just got back from 10 days in South Carolina. And so as two Southern Californians talking about hot, there is no definition of hot until you go to South Carolina in July.
Yeah, this is nothing for you. At least you're dry right now.
Oh, I think I went through like 30 shirts in 10 days. There's no reason to shower. You just sweat right through everything. But it was a lot of fun, and I'd never been to South Carolina before, so it was they call it the Low Country. It was a great place.
Welcome back. I'm gonna be getting some heat in Hawaii here in a week too. So glad we got some fun summer plans.
I love it. So it's funny. Usually there's a summer slowdown, and I would say over the last 30 to 60 days, things have picked up noticeably. So if things have been slow or choppy for the last 2 years, and they were slow in the winter and spring, and then things seem to be more active. And tell us about what you're seeing out in the marketplace. And before you even do that, to those who may have been under a rock for the last 20 to 30 years or 40 years, and they may not know MG Properties, let's start there. Talk about what MG Properties is, and then we'll go into what you're seeing in the market.
Sounds great. MG Properties, we are a owner operator of multifamily properties on the West Coast. The business was founded by my father, Mark, in 1992, and we have been disciplined to a fault, doing pretty much the exact same thing for the last 33, 34 years. Today, the portfolio is 110 properties. It's 32,000 units, and we are in 6 states. We are in Colorado, Washington, Arizona, Oregon, California, and Nevada. And we do our own in-house property management, asset management, construction management, spend a lot of time on that and find it very, very important to our business strategies. We've got 940 employees now, with 140 here in the corporate office in Sorrento Valley, Central San Diego, and the rest are at the properties doing the daily maintenance and management. We've been very active, especially over the last 10 to 20 years, and seeing a lot of very interesting trends in the market these days.
Wow. So that's it. Only 950 employees and what would you say, over 30,000 units?
Yeah, so we're at 32,000 units now. We recently closed a big portfolio we can talk about here shortly. A little bit more background on me too. Grew up in the business. Business was much, much smaller when I was growing up. So I was doing leasing and maintenance at the properties in San Diego growing up. We started expanding to new markets in 2000, about 24 years ago. Otherwise, we were primarily in San Diego. We did about 50 deals in San Diego before we started expanding, really kind of building the business model, building the structure. And we want to continue that growth. And we're long-term holders as well. So we typically hold for 7 to 10 years. We like to put on 55% fixed rate financing with interest only for the whole hold period. And we're very proud of our track record. Downside protection is the most important thing to us. And we haven't had any losses. And that Great Recession was a pretty big one back in the 2008, 2009 time period.
Yeah, who could forget that? So I do want to get into that larger transaction to the extent you can talk about it. But before that, I sing your guys' praises almost on a weekly basis, and it comes up like this, where I'll have a younger client, maybe they've been on the brokerage side or working for a large company, maybe private equity company or owner operator, and they're starting out and they ask me, they say, Andrew, should we syndicate our deals or should we do a joint venture? And I said, look, I personally feel if you've got the infrastructure, syndications will always be a better choice in that your fees are better, preferred returns are lower, promotes are higher, you're making all the decisions, but it takes literally a generation to build up that investor base of having coffees and lunches and dinners and drinks to cultivate that size of investor base. And I use MG Properties as an example of, look at what MG Properties has done. They're able to syndicate 30, 40, 50, $60 million equity checks. I don't know of any other company out there who can do that. And so I guess talk about, the history of MG, of how you guys have cultivated this type of investor base. It's amazing.
Yeah, you hit it right on the nail. It takes time. It takes a lot of good deals and a lot of good relationships. The first deal had 4 partners in it. It was 38 units in Vista, North San Diego. And then those 4 partners recommended a few more partners. And then those ones recommended a few more. And it starts snowballing after 33 years. So today we have 2,400 active partners. Not everyone goes into every deal. We have some people that are in 1 deal and we have some people that are in 80 deals. So just takes a lot of consistency, a lot of education on the investment type. There's a lot of tax benefits to our investments, as I'm sure everyone knows, and those are very, very valuable for wealth building. We try to take advantage of the 1031 exchange when we can, and it's just been very consistent, steady growth for 33 years. But it's very difficult to rush the growth of the syndication network.
Yeah. And so what's the average check size that your investors give you on an average deal?
We typically see an average check size around 250 to 280 per deal.
Okay. And that's, larger than a lot of syndicators. And what's the, I guess, average equity that you raise on a deal? And I'm curious, what's the largest syndication equity that you've raised on a deal, single deal?
Our average deal size is $100 million purchase price. And we're doing about 55% leverage. So we're averagely raising $45 million per deal. We do like to package deals together for diversification, and we try to get to that $80 to $90 million raise per deal. That's kind of our sweet spot. We know we can get to. We don't have to limit people. We don't have to cut anyone back. So in that $80 to $100 million equity raise is the ideal goal for us. And we can also allow new partners in. Many times on the deals that are smaller equity raises, we just go to current investors. So that's kind of the ranges that we're looking at today. And it's definitely, we're in a very blessed position where equity is not the issue. It's more about finding the deals, which we're definitely starting to see the deals pop up a little bit more these days. It's been a slower year, as you mentioned earlier.
Yeah. Now, before we get into the market, because I know I led with that, is it because you have such a large, diverse investor group, that's why equity is not the issue? Because in talking to most of my clients, equity has been the issue, especially if they're playing in the institutional world, or even if they're in the syndication world. Investors have pulled back over the last 2 years. What has your experience been?
Really the track record, the trust that we've built with our partners, and looking at all other alternatives out there. Real estate is a very, very excellent, tax efficient, risk adjusted investment today. And it's just been a long track record and a lot of trust. We also do JVs as well. So 75% of our business is high net worth syndications, what we've been talking about. 25% of our business is institutional JVs with large equity partners. And we find that it's good to do a little mix of both. You mentioned the control aspect. So you do have more control on the private side, which is, very beneficial. The promotes, the fees, they're slightly better. But there's so many good real estate opportunities out there, and some of them are too large, over that $80 to $100 million equity check. So very good to have other partners for those opportunities. And then on the private investment side, the main focus is the cash on cash return, the yearly yield. And on the larger institutional, they're more worried about or more interested in the back end return or the total return. Right. And we're seeing all types of opportunities out there. So we found that having that nice mix has been really beneficial.
Yeah. And so how are you seeing the market over the last, let's say 60 to 90 days?
We've definitely seen a lot more activity. There's been interest rates it's a wild roller coaster of a ride, but right now they've been coming down, and that's allowing some more players to come back into the market. The institutions have been mostly sidelined. They're starting to come back. There's been some big transactions this year. A lot of private groups have still been active or trying to be active. So there's still that bid-ask spread between the sellers and the buyers. A lot of deals aren't transacting, but we are seeing more deals transact as well. So last year we closed 8 transactions. It was about $850 million in acquisitions, and we felt very good about that in the current environment. This year we closed one larger deal here in our hometown of San Diego, and then a larger portfolio transaction, which was 10 properties with an institutional partner. And then we have 3 deals under contract right now, which is kind of the most active that we've been in the last year or two. And we're seeing a lot of good opportunities out there, some better returns, some better basis buys than we've seen over the last 10-ish years. So we're definitely excited about the opportunities. We do not believe it's the right time to sell. We will not sell anything this year.
Okay. You heard it here first, real talk. So, we work across many asset classes. I know you guys focus solely in multifamily. And in the office class, asset class, we've seen a ton of distress, a ton of note sales, both us representing borrowers who unfortunately, lost properties, and buyers of notes who are aggressively pursuing significant distress. In the multifamily world, we've seen some distress. We've had some borrower clients lose properties, but we haven't seen that onslaught of deal activity that I think everyone thought we would be getting. So of the transactions that you have executed on over the last 6 months, have any of them been note acquisitions or discounted payoffs where you're buying them and maybe the lender has agreed to a discounted payoff, short sales, anything of that nature?
We're right along with you. We've been very surprised there's not been more distress. And the fundamentals in the apartment world are still very strong. The lenders that have variable rate borrowers are working with them. And we thought we would have seen more distressed. All the deals we've bought, we wouldn't call them distressed, but we'd call them pressured to sell, just because it's not the best time to sell right now with interest rates up. There's not that much liquidity in the market. A lot of new development this year. Rents have been relatively flat, maybe slightly up. So everything's had either a fund end life, a variable rate loan coming due, a construction loan coming due, some form of pressure. But we would have thought by now we would have seen a lot more distress. Those variable rate borrowers, I mean, just the way that the rates have gone and the rate caps, I mean, it's significant.
What do you expect over the next 6 to 12 months as more loans come due? Do you think we will start to see the distress, or you think borrowers will just be able to kick the can down the road and live another year?
Depending on what interest rates do, there should be some more distress. Back in the Great Recession as well, we thought there was going to be more distress, and there wasn't as much as everyone expected. So probably going to be a similar story this time. There'll be some distress, depending on what a lot of these debt funds want to do. If they want to control the real estate, sell it at a loss. But we do expect some more distress, especially in some of the C class assets and a lot of the assets where the loan is underwater today.
Yeah. Hey, one topic I'd love to explore, which you touched on briefly, is rents. And you said rents, either flat or maybe slightly up in the markets that you transact in. Now, noticeably, you didn't mention Texas or Florida. I think, did you mention Phoenix and Vegas? Now, how are you seeing rents in those markets? Because a lot of my clients that are in the Sun Belt, Vegas, Phoenix, Texas, Florida, they are seeing rent contractions. And also besides just rental amount, they're just seeing the quality of their tenant base decline.
Yeah, so over our 35-year history, we have seen the markets all kind of equal out in the end, somewhere between 3 and 5% rent growth over a 10-year period. So after we just saw the massive growth years in Nevada and Arizona, where they were having 10, 20% rent growth years for multiple years, it's only expected for them to either slow down or go negative to get back to kind of averages. So looking back over the last year, our best performing markets are all in California. But if you look back at the last few years, on average, still Nevada and Arizona are ahead of those because of the very strong years. But we, in our underwriting, in our projections, we like to look at historical averages. And usually if you put those in, you're going to hit your numbers or beat them. So Arizona, Nevada, definitely going backwards a little bit or staying very, very consistent. But we are seeing markets that are still having strong rent growth, strong performance. Delinquencies have been getting cleaned up as well, especially in areas where restrictions were held longer than others. So we are seeing revenue growth again this year, and that translates to higher distributions.
Yeah. What about vintage? Because a lot of my clients, a lot of my capital clients have indicated to me that they're really just focusing on newer vintage, things that they could properties that they could buy below replacement costs, and they are moving away from anything built in the 80s and really anything built in the 90s. And so that whole market, which was so active in 2021 and before, are having tough times finding equity. What is your, I guess, what vintage are you focusing on, and have you experienced the same?
Historically, we've purchased right around 210 deals in our history, and we're almost at a 50-50 break-even point between two strategies. One is a value-add strategy, deals that are 10 to 40 years old, and then one is a core plus strategy, deals that are 10 years or newer. And in 2017 or 18, we saw a shift where the value add deals were not getting as much extra return that we would have liked to see. And we started buying a lot more core plus. So for the last couple of years, we've been buying more well-located, newer assets. And that has proved to be a good bet for us so far. We are still seeing that trend today. So most of the deals we're buying are slightly newer, slightly better location. Returns are still relatively close to the older properties or to the value add properties, but that's been our strategy.
Yeah. And how, when you talk to, sort of like I alluded to before, of talking to some younger people in the business and how to capitalize deals, and you guys have built such a great syndication machine and also have done institutional joint venture deals, and it definitely benefited from a 30-year plus track record. For somebody who's starting out, what advice can you give them as to the best path to this real estate business, the apartment business?
Something that worked really well for us that can translate to others is really understanding your business, understanding what deals are going to do the best, and then putting your money where your mouth is. So a big part of our philosophy is to be a big co-investor along with our partners. We never have less than 10% of the equity on any deal, and we have significantly more than that in our current portfolio. That really allows you to look at the deal differently, and it's very important for investors that are looking for GP sponsors to invest in. And I also think very important for syndicators to have some skin in the game. So that has been a big one of our philosophies since the beginning of our business.
Yeah. And let's pivot, as in our remaining moments, to the operational side of the business. A couple of lines of questions. First, you're president of MG Properties, you have over 900 employees. What do you do on a day-to-day basis? Are you more inwardly focused on the operations and your employees, or are you still outwardly focused in trying to get more investors, have JV relationships, acquisitions, looking at deals? So what do you do on a day-to-day?
Good question. I try to mix it up as much as I can.
Yeah.
After college, I went to CBRE for a few years before getting my master's, and then coming back about 10 years ago, I did a little rotational plan where I went for 2 years doing property management, 2 years doing asset management, 2 years doing acquisitions and investments, and then about 4 years ago took over as president in a more leadership role, which focuses a lot more on company strategy, looking out a few years, really trying to make sure that we're having the most efficient run properties, efficient run business. But just with the love for deals and looking at deals, I'm always going to be involved in the investment side of the business. We've got 9 full-time on the investments team here, and we're looking about 600 deals a year. So fun to analyze which deal is going to be the best, look at all the opportunities out there, what the returns look like. And then it's a relationship business. So really want to keep up those relationships, our reputation with brokers, lenders, principals, and everyone in the industry.
Yeah. Similar to me, my background is in law, and now I have a 65 person organization between lawyers, paralegals, admin staff, and I didn't go to law school to learn how to run a business. And how did you learn to, run a business, not just be in the real estate business, and learn how to source deals and source equity? But now you're in the people business of being the employer of almost 1,000 people. How do you like that aspect of it, and how did you learn that?
My biggest role model in the business is obviously my father, Mark. So seeing this business grow my entire life, just learning along the way. The very first employee on that first deal was my mom. It was run out of the house. And then very shortly after that, we had a one office little executive suite down the street. Then it turned into a 2 office, and then it grew into a corporate office, and it just kept growing and growing. So just learning and seeing the growth of our business has really taught me a lot. And, we've learned that when you feel like you need to make a new hire, when you feel like there's some room for growth, give it a try. And that's worked out well for us. We've seen just so much growth in our business, in our company, and we plan to continue that growth for many, many more years.
Yeah. And how about just retaining employees? In any business, it's so hard to retain employees. And we work with clients on internal equity plans and vesting schedules and programs to help share fees, profits, promotes with key employees. To the extent you're able to talk about just sort of generally, how do you build that into your culture and employment packages?
Yeah, no, it's a very good point, and kind of goes back to putting your money where your mouth is. For our key executive team, everyone gets a piece of the deal. So they're just invested along with everyone. And that also gets that mindset of picking the right deals, doing the best performance on the asset management side, the property management side. And we have been doing that since the beginning of the company. So everyone is significantly invested in the deals we're buying, getting cash flow along with our partners, getting total return along with our partners, and taking advantage of a lot of the tax advantages as well.
Yeah. So I don't know if your dad 30 plus years ago thought his company would turn into 1,000 employees, 32,000 units.
Never.
So sitting here today, if you fast forward to the age to when you become your dad's age, what do you think MG Properties will look like?
In the multifamily space, the fundamentals are very strong. It is a great investment asset for many of our partners, and we really believe in it long term. So we do need to keep growing to new geographies, to new locations, just to have more opportunities and to keep that growth going. So about every 5 years, we've added a new market. We're in 6 states, as I mentioned. I see us continuing that steady growth, adding a new market every 5 years, continuing the growth in obviously unit count and employee count. And we're just very blessed that we love the business, and Mark's still very active as well too. So it's been, obviously an amazing experience to work together.
Yeah. Well, I mean it when I said it, that the name MG Properties comes up a lot in my discussions, and in full disclosure, you guys are not a client of ours. We've transacted opposite a couple times, but just knowing the reputation that you guys have, and your ability to grow smartly and build an investor base is, you guys are, if not at the top, one of the top multifamily owner operators, not just in our region, but in the country. And so congratulations to the whole family and really the whole MG Properties team for the success that you guys have had.
Really appreciate it.
And so, Jeff, thanks for coming on. I know you're obviously very busy running 1,000-person company and small kids like myself. So we're just trying to hang in there day in and day out. So appreciate you coming on to the show and talking about MG.
It was great being with you today. Hopefully our talk brought a little luck to the Dodgers. I don't know the score. How they doing?
I've got them at 3-2 Dodgers. Giants are got a couple of runners on in the 5th. So we'll see. It's Kershaw's first game this year. So wait, we still have another minute. Are you a Dodger fan in San Diego?
No, not a massive baseball fan. Go to a couple Padres game a year. Okay. So any good home team, when they're playing well, it's just so fun to watch. I know the Dodgers dominate every year.
Yeah, well, we dominate every year in the regular season, and then we lose to the Padres, we lose to the Diamondbacks in the playoffs when it matters. So it's frustrating.
Okay, well, let's change that this year.
We'll see. Well, I can't get too excited in July. We'll revisit this discussion in October.
Awesome. Well, I expect a good report.
Yeah. All right, man. Thanks for coming on, Jeff.
Awesome. Great seeing you.
All right. Take
care.
Have
a good week.
Bye-bye.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.